Good morning, everybody, and welcome to our fourth IFRS webinar for 2019. Now, in this webinar, it's a very specific one, and it's aimed at our not-for-profit clients and not-for-profit entities in general. We're looking at practical issues when implementing the new AASB 1058. Again today, as always, I've got Kevin Frobus with me. So good morning, Kevin.
Good morning, everybody.
Um, so 2019 is going to be a huge year for not-for-profit entities. And the reason for that is in 2019, our not-for-profit entities have to implement 3 new standards, and that after in 2018, they've already adopted and implemented 1 new standard, being the financial instrument standard AASB 9. So in 2019, a really big year. They're looking at the new Leases standard, the new income for not-for-profit standard, and the new revenue standard. So what will we cover today? First of all, we'll look at the importance of 1 January 2019 for our not-for-profit clients. We'll look at AASB 15 and in particular what it would mean for not-for-profit entities. The main focus, however, is AASB 1058, income of not-for-profit entities. Then Kevin will look at AASB 16 leases and specifically peppercorn leases. We'll touch on that very briefly. And the reason why we're looking at all these standards for not-for-profit entities is whenever we speak to not-for-profit entities, although the conversation often starts with AASB 1058, it very easily changes to a discussion around all 3 of these new standards. Then we'll have a discussion around questions directors should ask. And we've got overall questions as well as questions specifically focused on AASB 15, AASB 1058, AASB 16. We talk about next steps, what you should be doing now before we get to 1 July 2019, the date of implementation for most of our not-for-profit clients. And we ask the question, do you need assistance? And we do offer some potential assistance, newsletters, webinars, live ones, recorded ones, and some people that can help you. So if we start with our very first section, which looks at the importance of 2019, we've given you a bit of a table of the 4 new standards, and you can see here AASB 9 financial instruments should already be implemented, bedded down. If you've got a 31 December year end, would have already finalized your financials with AASB 9 in it. If you've got a 30 June year end, you're 2 months away from your first financial year where you've implemented AASB 9. However, if we group AASB 15, 16 and 1058 together, if you've got a 31 December year end, you would already be within your first year of implementing and applying these standards. And if you've got a 30 June year end, you're actually very close to the start of your first year of implementing these standards. If we put it on a timeline, you can see if you've got a 31 December year end, you're already within that first year. And if you've got a 30 June year end, it's another 2 months and you're in your first year. So really important for our not-for-profit entities to look at these standards and what it would mean for them. So if we start with AASB 15, revenue from contracts with customers. Now, a lot of people ask us, so why do you look at AASB 15 and AASB 1058? And a lot of people, not-for-profit clients, say we would like to make an accounting policy decision to only apply AASB 15 or only apply AASB 1058. It's very important to understand that if you're a not-for-profit entity, you would have to apply with AASB 15 and AASB 1058, or potentially apply with both. Or apply both. You will have to have an accounting policy that requires you to consider and assess for each and every transaction whether AASB 15 is applicable to that transaction or whether AASB 1058 is applicable to that transaction. So the starting point of your accounting policy around income recognition will have to be, this is the process that we go through in order to decide whether AASB 15 or AASB 1058 is applicable to this particular contract or this particular transaction. It's not possible for a not-for-profit entity to state that we're only applying 15 or we're only applying 1058. It's just not possible. So that's point number one. So if we look at AASB 15, and before we actually look at the details, one should ask the question, so when would a not-for-profit entity apply AASB 15? And at BDO, we've developed a decision tree to guide you. And I would suggest that this decision tree, or maybe the words within this decision tree, is the starting point for your accounting policy note around income recognition. Your first question would be, are the funds received for the purpose of acquiring or constructing a non-financial asset? Because if that is the case, if you are receiving funds or a donation or a government grant or a bequest, so if you receive any funds for the purpose of acquiring or constructing a non-financial asset, a building, etc., if you answer yes to that, you have to apply AASB 1058 and in particular paragraphs 15 to 17. So no way you can apply AASB 15 in that situation. If you say, no, I haven't received funds for the purpose of acquiring or constructing a non-financial asset, your next question is, does the transaction occur in a contract with a customer that created enforceable rights and obligations? So if you say no, you outside the scope of AASB 15 and you have to go and look at AASB 1058. However, if you say yes, there's another hurdle for you to jump before you can apply AASB 15. If we just ponder this question a little bit more, does the transaction occur in a contract with a customer that created enforceable rights and obligations? What do we mean by that? It means that in the past, or if you've received a government grant and if you don't spend the money or received on a particular purpose, there's a requirement to repay the money to whoever provided this grant. In that situation, that transaction occurred in an enforceable contract and there are enforceable rights and obligations. Now, the easiest way to get to enforceability and to jump that particular hurdle is if there's a requirement to repay. However, the standard does explain there could be other mechanisms that also lead to enforceability. Maybe there's a significant penalty involved. So it's not as simple as, do I have to repay if I don't use it for a particular purpose? Although that is one we see very common in practice and a very easy way to jump that particular hurdle. If you say, yes, I've got these enforceable rights and obligations, the next hurdle, and this is an extremely important hurdle, is, does the contract include sufficiently specific performance obligations? So that would mean sufficiently specific promises by this not-for-profit entity to transfer goods and services to customers. And only if we have sufficiently specific performance obligations around transferring goods and services, could you or would you, as a not-for-profit entity, be required to apply AASB 15? If you do not have sufficiently specific performance obligations, you have to apply AASB 1058. Now, another thing that I just want to highlight here is a number of not-for-profit entities have this vision or this dream that they want to apply AASB 15 because they believe once they get to AASB 15, they would automatically be required or allowed to recognize revenue over time. Now, even if you are in AASB 15 as a not-for-profit entity, you will have to go through the 5 steps in AASB 15. And only if you get to step 5, if you meet very specific criteria, would you be able to recognize revenue over time. However, I do understand why not-for-profit entities are aspiring to get to AASB 15 because at least then there's an option or an opportunity to get to recognition of revenue over time, where if you end up in AASB 1058, it quite often, and I would say quite regularly, lead to recognition of revenue upfront when you receive the grant or when it's allocated to you. So that's maybe just one thing to be aware of. The other thing to be aware of is currently not-for-profit entities use AASB 1004 contributions. And there are different interpretations currently of AASB 1004. And one of the interpretations that I'm aware of is some people would currently say, if I receive money from a government as a government grant, and I receive the cash, and there's a requirement that I have to repay this money if I don't spend it on providing food to the homeless, as an example, then I have to repay it. In that situation, they would say, when I receive the cash, I would say debit cash, and I'd credit deferred revenue or a liability, and as I spend the money to provide food to the homeless, I would recognize the income. Now, that is a interpretation currently under AASB 1004, which is acceptable under AASB 1004. Now, a lot of people thought if that's what they've been doing under AASB 1004, once they get into the new standards, they would be able to continue to do that without really thinking about it too much. Now, let's just test that particular example on this decision tree. In the first question, are the funds received for the purpose of acquiring or constructing a non-financial asset? No, it's to provide food to the homeless. Second question, does the transaction occur in a contract with a customer that created enforceable rights and obligations? Yes, because if I don't spend it to provide the food to the homeless, I have to repay it. But then the third block in yellow, does the contract include sufficiently specific performance obligations? Now, to receive money to provide food to the homeless, which might be your mission statement or which is the overall statement, is not sufficiently specific under the standard. Because how do we measure progress? How do we measure once you've transferred the goods and the services to the customer? The standard says sufficiently specific requires something like you have to provide 3 meals per day for 52 weeks of the year, and you have to do that for 3 years, for example. So there has to be something specific, sufficiently specific that we can determine when have you done it. And once we can determine the extent to which we've done it, we can therefore recognize potentially the period over which we recognize the revenue. So in my very simple example, which gave us a debit asset, credit, liability when we receive the cash, and then we spread it as we spend the money feeding the homeless under AASB 1004, looking at the new standard, and even if we look at this decision tree, we would not get to the recognition of revenue over time, because the third yellow block, we would say it's not sufficiently specific. Therefore, we'll have to apply AASB 1058, which most often, and in this case, would lead to the recognition of the income or the revenue on day one. So it's really important that when not-for-profit entities look at these new standards, they keep in mind that currently they're doing certain things under AASB 1004. It was a vague standard, it was a grey standard, it was a problematic standard, and potentially you're doing, and our clients are doing very different things. So that's your starting point. What am I currently doing? And then when I look at these new standards, what do these new standards require me to do? And to what extent is it different? And there could be a lot of differences. And the more we work with our not-for-profit clients, the more differences we pick up. And that is maybe one, or this particular example that I've just explained is maybe one that not everybody picked up right from the start. It's only when we delved into the detail that we picked up that this is a big difference for many clients. So if you do end up in AASB 15, and I'll go back to the previous slide, if you jump all these hurdles and you do end up as a not-for-profit entity applying AASB 15, the core principle in AASB 15 is that you recognize revenue to depict the transfer of the promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. And I would expect that core principle to be part of your accounting policy. So I would imagine your accounting policy will start with that decision tree. And then once you are in AASB 15, this is the principle. Important to note that the core principle refers to promised goods or services to customers. Now, a customer is a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. Now, if you look at that definition of a customer as a not-for-profit entity, you might say this is problematic. The standard clarifies that a customer could also be if you, an organization, receive funding from government and you then have to spend that money on behalf of government to feed the homeless or to provide counseling services to people who are rehabilitating from drug or alcohol problems. But in that situation, although you are providing these goods or services to members of the public in a very specific group, you are still doing that as a service to government who provided the funding to you, and therefore it's still within the definition of a customer. You would remember under AASB 1004, there was a lot of discussion around whether it would be captured or not. And they've tried to clarify here that the definition of customer is wide enough to deal with this particular situation where you receive funding from an entity and you're not necessarily providing the good or services to that particular entity, but you're providing it to other people on their behalf, and that is captured. Now, the core principle is then broken down in AASB 15 into 5 steps. So the first step is you have to identify the contracts with the customer. Step 2 is to identify the separate performance obligations. Remember, in our situation, if we're a not-for-profit entity applying AASB 15, we know there would be sufficiently specific performance obligations. Otherwise, we would not be applying AASB 15 to start with. So identify the separate performance obligations. We would determine the transaction price, and I would say that's the total transaction price. And in step 4, we take that total transaction price that we've determined in step 3, we allocate it over the separate performance obligations that we've identified in step 2. And then in step 5, and this is really important, and this is the bit that not-for-profit entities should not rush over, is we recognize revenue when a performance obligation is satisfied. And that performance obligation could be satisfied at a point in time, or it could be satisfied over time. The general principle is that we satisfy a performance obligation at a point in time. However, they give us 3 situations where you can recognize revenue over time because we satisfy the performance obligation over time. So that is an important criteria to look at. Do we satisfy the performance obligations at a point in time or over time? To determine the timing, the amount of revenue recognition. Now, in our session today, we don't have time to look at the 5 steps of AASB 15 in great detail. And therefore, I've put together a slide that says and refers you to our webinars. Now, first of all, we've got webinars scheduled for 2019. And I'll show you our webinars for 2019. We've already, in February, looked at practical issues when we implemented IFRS 15. You can see for the rest of the year, in July, we'll look at disclosing the impact of implementing IFRS 15. In October, we'll talk about lessons learned from implementing IFRS 15. So quite a number of webinars this year that's just aimed at looking at IFRS or AASB 15. So I've made a list here for you as well. Maybe more importantly, if you want more information on AASB 15, you can go back, and again, I've given you a link there. Well, you can go back and look at 2017 and 2018 webinars on AASB 15. So in June in 2017, we did an overview of IFRS 15, and then we had some additional webinars, in total 6 webinars during 2017 and 18, talking about particular aspects of AASB 15. If you want to look specifically at step 5 and when you can recognize revenue over time, the best webinar to look at would be the June 2017 one, an overview of IFRS 15, and we focus particularly on step 5. In that webinar, we include a number of decision trees to help you to make that decision. However, I thought let's try and provide some example of how a not-for-profit entity would apply AASB 15 and when they would apply AASB 15. So the first example I've included is on the 30th of June 2018, an alumnus transferred 2 million cash to University A as an endowment. Now, it's very important that we go and look at the terms and the fine print in all these agreements to decide whether we apply AASB 15 or AASB 1058. And once we've decided that, exactly how would we apply it? So contracts are becoming more and more important, and to do a proper contract analysis is critical. There's no one size fit all. So the terms of this particular endowment is, first of all, the 2 million cash can be invested at the university's discretion. University A is required to provide the annual scholarship for one student's accommodation for a defined period of 30 years. So we've done some calcs and we got the actuaries involved or corporate finance, and they said that the expected cost of this annual scholarship over the next 30 years is 1.85 million. Now, if the university breaches the terms of this endowment, or they don't provide the scholarship for this one student every year, the university is required to return the real value of the principal to the alumnus. So definitely we can see enforceability. And the entity's reporting date is 30 June. So in this situation, we would say on the 30th of June, when we receive the cash of the 2 million, we debit cash of 2 million, we credit contract liability of 1.85. So that is the expected value of what it would cost to provide this accommodation to the one student for 30 years. And the difference we recognize as income immediately in terms of AASB 1058, because that income of 150, the substance of that 150 is a donation. They gave us 2 million. We are committed to spend 1.85 million, and the other 150 is a donation, and that we can use for whatever purpose. And then every year, at the end of the year, we would say debit that contract liability and credit income. Now, I've made the rude assumption here, or crude assumption that the 1.85 is recognized evenly over the 30 years. And I appreciate that that's not right. We have to take into account time value of money, etc., and wouldn't be even. However, that's my calculation and my assumption to illustrate. So in this situation, because we said we have an enforceable contract, because we said we've got sufficiently specific performance obligations. What is the specifically sufficiently specific performance obligation is that we have to provide this accommodation to one student for 30 years, and we can measure progress. We can measure to what extent we've done that. So that's the first example. Another example, in this example, we've got a multi-year cash grant. So the local government enters into an agreement with the state government in the form of a memorandum of understanding to receive a multi-year cash grant of $90,000 from state government. And it's received in full on the 24th of June. And I want you to just take note, it's received in full on the 24th of June. The grant is to fund education programs over 3 years commencing 1 July 2018, with the objective of increasing the literacy of students of a specific rural area. Now, the Memorandum of Understanding outlines the agreed activities of education programs that are tailored to the literacy needs of the students. Now, the local government is able to identify when its specific obligations are satisfied and expects to fulfill its promise to provide the agreed activities. So we can see that we've got sufficiently specific performance obligations. The state government can enforce the repayment of the grant if the specified activities are not undertaken. So we've got an enforceable agreement, and the entity's reporting date is 30 June. So we received all the money on the 24th of June. Our reporting date is 30 June. We know we're applying AASB 15. So in this instance, we'll say on the 24th of June, when we receive the cash, debit cash 90,000, credit the contract liability 90,000, and then over the next 3 years, on the assumption that we're spending it evenly over the 3 years, we'll say debit the contract liability, credit income. Again, I've made an assumption that we're going to spend the 90,000 evenly over the 3 years, and that we're satisfying our performance obligations evenly over the 3 years. It could be different, but that's the assumption we've made in this situation. Now, before we go on, I also want to ask a question, and I've asked you to specifically note on this slide in the first bullet point that we received in full the 90,000 on the 24th of June, and we got to these journals. And now I want to ask, what if? What if we received the documentation outlining that we've received the government grant of $90,000 and we received the documentation and it's signed by government and us on the 24th of June 2018. However, we actually received the cash in July 2018. What do we do? So as soon as you've been allocated this government grant on the 24th of June, you would say debit a receivable, a grant receivable of 90,000 and credit a contract liability. And then if you receive the cash in July 2018, you would say debit cash and credit grant receivable. So very important, and again, a subtle difference. It's something that I've picked up, maybe not the way people have accounted for AASB 1004 in the past. Some have, but I would say most didn't. They waited for the cash flow. So important to take a note of that again. When you transition to AASB 15, and very similar transitional requirements to transition to AASB 1058, there are two options available. Now, the one is a retrospective method, and the other one is a cumulative effect method. Now, again, I want to warn you, a number of people have assumed when they saw cumulative effect method, they've assumed that we do not have to apply these standards retrospectively. We can only apply it to new agreements that we enter into after the 1st of July 2019, if that is your date of initial application for a 30 June year end. And that is incorrect. These two options for transitioning are disclosure options only. These standards, AASB 15 and AASB 1058, have to be applied retrospectively. The calculations have to be done retrospectively on all open, ongoing arrangements, agreements. However, you've got a choice on how you disclose the impact. So if we look at the disclosure alternatives, there's a retrospective approach where you apply IFRS 15 retrospectively for each prior reporting period and you disclose it for each prior reporting period. Whatever changes happened before the start of your earliest comparative period will usually be the start of your comparative year. Whatever happened before that date, you adjust against retained earnings on that particular date. So if you're looking at 30 June 2020 financials, if your date of initial application is 1 July 2019, everything that happened before 1 July 2018 would be adjusted and disclosed against retained earnings on the 1st of July 2018. And you've got a choice to use for practical expedience, and that is just to make it the calculations a bit easier if you do the full retrospective disclosure approach. If you look at the cumulative effect method, which is a disclosure alternative, your cumulative effect is shown as an adjustment to retain earnings on the date of initial application. So in my example, 1 July 2019. So the adjustment is at 1 July 2019. For your comparative periods, so for your comparative year that ended 30 June 2019, you would still disclose your pre-IFRS 15 and AASB 1058 numbers, and there's one practical expedient that's available. So I thought I'll just try and explain the difference between the two methods in looking at an example. So in this situation, I've tried to base it on our previous example, number 2, similar numbers. So in this situation, what I've said, if we look at 3 financial years, so let's say financial year ending 30 June 2018, and we look at the financial year 30 June 2019, and we look at financial year ending 30 June 2020. And if we make the assumption here that 30 June 2020 is the first year that we'll be applying the new AASB 15, at 30 June 2019 will be our comparative year, and financial year 30 June 2018 and all the years before that obviously would be the years before the start of our comparative year. Now, if we look at how did we recognize income previously, previously under the old AASB 118 or AASB 1004, we recognized the income when we received the money, and we recognized it in 30 June 2018. That's my assumption. If we look at the new AASB 15, we realize that you'll recognize 30,000 30 June 2019, 30,000 30 June 2020, and the other 30,000 will be in 30 June 2021. So you can see there's a difference between what we've done in the olden days and what we're now going to do under the new standard. So if we do the full retrospective method, what would the disclosure look like under the full retrospective method? So first of all, what you'll see, full retrospective method for 30 June 2020, you'll see your income of 30,000. For 30 June 2019, your comparative year, you'll see income of 30,000. But everything that happened before the 1st of July 2019, in all the previous years, you'll have to remove. And you remove that against opening retained earnings at the beginning of your comparative year. So we'll do that against opening retained earnings on 1 July 2018. So you can see that if you go retrospective, you have to remove everything before the beginning of the comparative year, and you have to now account for the new standard, and you have to disclose it correctly in the comparative year and the current year and going forward. If you decide, I don't want to do full retrospective disclosure, I want to do modified or cumulative disclosure, you'll only fix your first year, which is 30 June 2020, and you'll say, I know 30 June 2020, my income recognized should be 30,000, so that's what I'll put in. However, everything that happened before this current year also have to be fixed. So I also have to do a retrospective calculation. However, I'm not going to adjust my 30 June 2019 disclosures, my comparative year. I'm going to keep it what it was under the old approach. And that cumulative adjustment, so that is the 90,000 that was recognized in 2018, and then remember I should have recognized 30,000 in 2019. The net effect is a correction of 60,000. I'll adjust that and disclose it in our opening retained earnings in the current year. So you can see under full retrospective method and modified retrospective method, under both of them, I have to do the calculations, as in when was the revenue recognized, when should it now be recognized. That stays. The first two rows in this table stay. It's just a question of how will I disclose it in my 30 June 2020 financial statements, and there's a different option, or there are different options for disclosure purposes. Your journal entry at the date of initial application 1 July 2019 for both disclosure options will be exactly the same, because you will have to say debit retained earnings opening balance 60,000. You'll say credit income in the current year and credit or contract liability, and that's the income that you'll recognize in the following year, 30 June 2020. So it's really important that you understand the difference between the journal we process on the date of initial application, which is based on retrospective calculations versus how we'll end up disclosing it in our first set of financial statements. So that's what I try and illustrate in example 3. Now, in this slide, I'm trying to ask a what-if question, which I've discussed earlier when we looked at example 2 again, but I just want to reiterate this. What if the government grant was allocated before reporting date? So we received the paperwork before reporting date, and the cash was only received after reporting date. And just for this slide, assume that the grant is recognized when it's allocated or received. So as soon as it's allocated, you would say debit grant receivable, credit grant income. And after reporting date, when you actually receive the cash, you'll say debit cash, credit grant receivable. So what I want to point out here is the fact that as soon as a government grant is allocated, the paperwork been finalized, you book that grant receivable. So that is AASB 15. If we move on and we look at AASB 1058, income of not-for-profit entities, we have to start with the same place. So when would AASB 15 apply, and when would AASB 1058 apply? Now you can see two instances here where AASB 1058 would apply. First of all, in the first question, are the funds received for the purpose of acquiring or constructing a non-financial asset? If you say yes, then you apply paragraphs 15 to 17. However, even if you said no, and in the second yellow block you have an enforceable agreement, and in the third yellow block you don't have sufficiently specific performance obligations, you could still end up applying AASB 1058. Now, the best way to explain this is to look at some examples. Now, in the first example, example 4, I look at cash received for the construction of an asset. The state government makes a cash grant of $100,000 to a hospital to acquire 16 intensive care hospital beds that are to be controlled by the entity and used in its operations. So they're saying, state government says, here's the money, hospital, buy the beds and use the beds. Now, 6 beds are acquired by the hospital in its first purchase and the remaining 10 a few months later. Hospital X determines that the 100,000 grant is an asset that Hospital X acquired for consideration that is less than the fair value, and it's to further our objectives. The grant is within the scope of AASB 1058. We control the financial asset of 100,000, so it's within the scope of AASB 9. And in accordance with paragraph 16, Hospital X recognizes the grant initially as a liability at the point in time when it obtains control of the cash, and then Hospital X recognizes income as it acquires and controls the hospital beds. So what we're saying is when we receive the cash, the standard specifically says debit cash, credit, and obligation. I've received the cash, but I've got an obligation to spend it on hospital beds. So that's the first step. When I make my purchase, I would say debit my obligation and credit income. And I would also say debit equipment because now I have the hospital beds, and I credit cash. So what we're trying to do is once you get the cash, you don't book the income on day one. You only book the income as you spend the cash on the acquisition of these non-financial assets. So that's the first example. When you get to for the journal entries for the second purchase, you say debit the obligation, credit income. I've now bought this second lot of beds, the 10 beds. So I book an asset for the beds and I credit my cash. I think really important, if you receive a government grant and the government grant is specifically to acquire or construct non-financial assets, you specifically look at paragraphs 15 to 17, nothing else. You don't consider the rest of 1058 or 15. It specifically directs you to those 3 paragraphs. And a lot of our clients are in that situation, receive government grants to acquire assets. If you look at other transactions where we apply AASB 1058, so it's not just where you've received cash to buy non-financial assets. AASB 1058 applies to two broad types of transactions. The one is for the receipt of volunteer services, and the other is transactions where the consideration to acquire an asset is significantly less than the fair value, principally to enable a not-for-profit to further its objectives. So you've received money, or you've received an asset at less than its fair value. You bought it at a reduced price, and the reason they sell it to you at that reduced price, or the reason they donate the cash to you, is they want you to further your objective. So that's the broad types of transactions within the scope of AASB 1058. I'll briefly touch on volunteer services. So currently, our not-for-profit entity clients and most not-for-profit entities would not account for the receipt of volunteer services. The standards allow an accounting policy choice to not-for-profit entities, especially if you are a not-for-profit entity in the private sector. For public sector, they are forced to account for volunteer services. So the accounting policy choice says that you can account for these volunteer services at fair value, which would just mean that you're including an income of volunteer services, but you also simultaneously include an expense in relation to those volunteer services. The reason people would do that, or entities would do that, is to show a fair reflection of what it would really cost to run that organization if you didn't make use of volunteers. So that is an option that's available. Most entities that I speak to are very hesitant to do it that way because they are concerned about the cost to determine the fair value of the volunteer services on an ongoing basis. So if we focus on transactions that to further your objectives, so you receive assets or you receive cash, there's a process to go through around recognition and measurement. Now, the process is we start with the asset side, and you determine if I receive cash or if I receive a particular asset. You first look at what is the applicable accounting standard to account for whatever I've received. If it's cash that I've received, I apply AASB 9 financial instruments. If I've received a property, I apply AASB 116 property, plant and equipment. If I've received an intangible asset, if I've received inventory, I pick the appropriate accounting standard and I recognize the asset. Then I say, what do I credit? Then you try and identify, is there an appropriate accounting standard that would tell me what to credit? For example, and they list a number, should I apply AASB 15 because I have sufficiently specific performance obligations? Should I apply AASB 16 around lease liabilities? Should I apply or should I account for a contribution received by an owner? So a number of alternatives. So you look at existing accounting standards and you see if there is an appropriate credit. And if there is no appropriate credit, and often there aren't if you're within AASB 1058, the difference between A and B, usually it's A, would be recognized immediately in profit or loss in terms of paragraph 10. But it's a process. Start on the debit side. Can I identify the asset, find the appropriate standard, then look at the credit side. What do I have to credit in terms of Australian accounting standards? If nothing, credit income immediately. So I'll give you an example. Example 5, a multi-year cash grant. Local government enters into the same agreement. They give us 90,000. We receive it on the 24th of June. Second bullet point, the grant is to fund education programs over 3 years, commencing the 1st of July 2018. The objective is to increase literacy of students in a specific area. The third bullet point is important. The Memorandum of Understanding does not specify the activities the grant must be used for. So it's a very general, improve literacy of students for a 3-year period. Please note that a time period of 3 years is not sufficiently specific. Sufficiently specific cannot be time-bound. It has to be around activities, goods, services that are sufficiently specific. Goods, sufficiently specific. Services, sufficiently specific. No relationship or time-bound is not enough. There is enforceability, but not sufficiently specific performance obligations. How do we account for this? And the journal is just debit cash, credit income, 90,000. Again, I asked the question, if we didn't receive the cash on the 24th of June, but we received the paperwork, we received the cash in July, the journal would be debit receivable credit income. And then in July, when we receive the cash, it's debit cash credit receivable. So I have very briefly and at a very high level tried to discuss when AASB 15 should be applied and very high level how it should be applied, as well as when AASB 1058 should be applied and very high level, what does that mean? And we've not explored all aspects. It's an introduction. If you need assistance, please contact us and we can look at it a bit further. Kevin, I'll hand to you to look at IFRS 16 and in particular peppercorn leases for our not-for-profit entities and clients.
Thank you, Aletta, and I must compliment you on moving through that content in the time period. It was actually very well done. I learned a lot myself. So now we'll move on to IFRS 16 leases. As Aletta had mentioned earlier in the session, this is not actually under AASB 1058, but in the not-for-profit sector, because of the application dates being the same, it often comes up in conversation along with AASB 1058 and 15. So we'll just quickly have a look at this. And the big change, of course, for leases is for lessees, the end of the road for operating leases. I think that message must have communicated down by now. So with operating leases and with lessees, the transition is to the right of use model, where all leases, with a few exceptions, would be capitalized onto the balance sheet with a right of use asset and a lease liability. In terms of the not-for-profits, the peppercorn leases is the tricky bit. Peppercorn leases, of course, are those, and this is defined in the standards, where the lessee has a lease that is significantly below market value terms, and the conditions are there principally to enable the entity to further its objectives. In that scenario, the rights of use asset must be brought on at fair value. This is quite unique to the not-for-profit sector. And it is, of course, creating a number of issues in the industry, such as how to fair value a right of use asset. But nonetheless, that's the requirement for not-for-profit entities. The lease liability is still measured at the present value of the lease liability, which is the same as the for-profit entities. And at transition date, that would be equal to the amount not paid at the date. And of course, there's going to be a difference, and in that scenario, and the difference in that scenario would probably be accounted for, or will be accounted for, in accordance with 1058. And it may have a number of other standards that apply to the credit, but most likely potentially income under 1058. Now, the developments that have come from this section, or the latest developments that have come from this section in relation to peppercorn leases, is that an amendment has been issued by the Accounting Standards Board. I'll come to that in a moment, but let's just have a look first at an example that demonstrates what we've just spoken about. This is a very quick example. We have a school year that it's entered into a 30-year lease for a building. It's a $100 per annum lease contract, and you can see already that we have the peppercorn lease coming through there, because $100 per annum to use a building at a school must surely represent a lease that is significantly below market terms and conditions. At the inception of the lease, the entity has assessed the terms and conditions and has determined the fair value of the right of use facility to be $360,000 for the 30-year period. that would therefore be the right of use asset fair value that's been determined by the school at inception. The leased premises must be used to provide education services, or School A will no longer be able to use the facility. So this triggers the application of AASB 1058 because the lease has been provided to the school to be able to principally further its objectives as a school. No other conditions specified in the lease. And in this example, we've assumed that the net present value of the future lease discounted at the school's incremental cost of borrowing of 5% is 1,537. So that would obviously be the lease liability determination. So looking at the journal entry in this case, debit right of use asset of 360,000, credit lease liability of 1,537, and credit income being the difference, the income being recognized under AASB 1058. So you can see how 1058 is applying and interacting with AASB 16 at the same time. Now, looking at this slide, there are a number of issues that trigger at this point. One of them that has come up in recent days or in recent weeks is the incremental cost of borrowing. We're not going to get into that today, but I just want to point it out how to determine the incremental cost of borrowing for a not-for-profit. In this case, it's a 5% incremental cost of borrowing. That by itself could be a tricky issue, and you may want to actually seek some guidance on that. But the lease liability you can see is significantly below the value of the right of use asset, being the 360,000. But other problems arise here. How do you actually work out the 360,000? This valuation issue of working out the 360,000 itself has presented problems to the industry. And as a result, the most recent development from the AASB is a deferral or temporary option to not actually measure the right of use asset at fair value. So I'll read this slide so we can just get across all the words. The AASB has decided to provide a temporary option. That's quite important. It's a temporary option for not-for-profits to not measure a class or class of assets, the right of use assets, at initially the fair value. And principally, or one of the main reasons for that, is because guidance needs to be developed on how to actually do that valuation. It's a valuation exercise, and valuing the right to use an asset in a not-for-profit that is subject of a peppercorn lease has proved somewhat tricky. This temporary option would also avoid the requirement that some not-for-profit private sector entities at the lower levels of the reporting thresholds would have to apply this model, which might otherwise not have to apply it while the ACNT legislative review is underway. Now, how long will this temporary deferral option remain? Well, it'll remain in place until such time as guidance has been developed. And how will entities apply the deferral option in their 2019 financial statements? Well, really what you're going to do if you are applying this temporary option to the class of the asset is you actually just recognize the right of use asset as the present value of the payment. In other words, in our previous example, we had an amount of $1,537 being the lease liability, and that would then be your right of use asset. You wouldn't actually be bringing on this $360,000 because you would be applying the temporary option not to actually measure the right of use asset as that amount. So your lease liability and your right of use asset would effectively be equal to each other. That would present a nice symmetrical cost approach to these accounts. And most not-for-profits that have worked with us on this scenario are actually taking that option, that temporary option, not to apply. This last slide here actually just summarizes what I've actually spoken about. How long will the temporary deferral option remain? Until such time as the guidance is in place. And that just summarizes that the right of use asset, if the deferral option is elected, is effectively the present value of the lease liability. All right, now, one point to make here is the last bullet point on that slide. Additional disclosures are still required. It's important to note that the deferral or the choice of this temporary option not to apply the fair value model on the right of use asset does still require certain disclosures to be made. So please don't forget that. Moving forward then to questions directors should ask. Now this section here is kind of bringing it all together. Let's going to click on a link that we've provided to you there. This is a web content that we put together in collaboration with the ARCD. Questions directors should ask to ensure that organizations are applying. Now this is actually designed for those persons responsible for the governance of not-for-profit entities. There is a section at the top that is a sort of a global section that covers all the new standards, and then as the letter is demonstrating, there's actually questions for all the relevant standards, 1058, 15, and 16. They are governance questions. So these are the sorts of questions you should be asking of your management if you're a larger not-for-profit, but really anybody who's responsible for running or directing a not-for-profit can use this page to almost a checklist to make sure you've covered these things off. Going back to our slides, we've actually put some of these questions into our slide pack. Let's bring it back onto the screen. I'm not going to deal with each question on these slides in the interest of time, but there are one or two along the way I'd like to point out. From an overall question point of view, you really want to start asking your question from a governance point of view is how do these accounting standards impact the profit of the organization, not only at date of implementation, but also thereafter. And you are going to find that because of the various transition options and accounting policy and judgment choices that are available to organizations, is that those people who are in charge of governance might want to start asking questions about what are the various options and judgments and policy choices, what do they do to the number on transition as well as to our profitability for a number of years thereafter, so that you can actually make an educated decision as an organization about which choices you might make in terms of policy elections and transition methods, so that you don't get caught out at a later stage by impacting your equity or your profit in a particular way. So make sure you have a real understanding of the options available and the impact of those choices, not only at transition, but also in years thereafter, to make sure you actually choose the correct approach that gives you as an organization the best outcome going forward. That also, of course, will then flow into things like how do you incorporate that into your budgets and into your forecasting. Moving on to the next slide. On this one, it was just about communication. I mean, the number of questions on this slide, and remember that they are repeated on the ARCD website that we've provided the link to you. But the one I want to talk about here is communication. How are you going to communicate this, not only within your organization, but to those providers of funding and to granting? A number of not-for-profits have indicated to us that as these standards are effective and they start to change profitability and they change the balance sheet and the liability numbers, that it actually is impacting the story that they tell, that they provide their funders and their grantors. So make sure you start to communicate to those, shall we call them investors, the impact of these new standards so that it doesn't disrupt the flow of funding to you as a not-for-profit. There can be serious damage if your investors and your grantors don't understand what these standards are doing, and you start to get questions like, well, you've got a lot of money in the bank already, or you've got a very nice high profit one year, so what do you need funding for? And you don't want that to be disrupted in terms of actually trying to achieve your objective as a not-for-profit. Moving along to the next slide, the one I wanted to speak about on this one here was really just making sure that you've documented in your position papers your policy choices, your judgment calls, and you've updated your accounting policy manuals to reflect the decisions that you've made before you actually then go and implement transition. And this kind of linked back to the first point I made. Make sure you understand the policy choices that are available to you and the judgments that are required before you actually apply them, so that you actually have as a governance decision, you've made these decisions as an organization in the best interest of your organization, and that they are then embedded and locked into your policy manuals and your position papers going forward. And then finally, on the last slide in this section, it's about technology. This is the third point on this slide, but it's about the technology needs. And we find this in particular, for example, with things like leases. You know, the more leases you have, you might need to consider things like technology changes that need to be made. How are you going to actually maintain the accounting systems and the records to keep these systems going, or to keep these accounting standards being managed into the future? Um, you know, BDO's got, for example, a product BDO lead that are managing leases, and there's many other technology tools out there that are dealing with leases, for example. And you are going to find that some leases are complicated and that they require you to maintain this information on an ongoing basis, to make sure you can reassess and modify leases as they go, to generate the information, the journal entries, and the records required to account for these accounting standards on an ongoing basis. So make sure, as a governance question or a question the director should ask is, have we got the right tools and technology in place to manage these on an ongoing basis? I'm going to hand back then to Aletta to take us forward through to next steps.
Thank you very much, Kevin. I forgot to unmute myself. I was talking to myself here in Melbourne. Kevin, thank you very much for doing that. I know I haven't left you a lot of time to do that, so thank you. If we look at the next steps, if you look at AASB 15 and AASB 1058, I would ask you, do you or your clients receive government grants? What other funding do you or your clients receive? And have you looked at those funding arrangements, government grants, to make sure you've determined whether AASB 15 or AASB 1058 should be applied in the first instance, and then how it should be applied? If you are a school, there are new guidance or frequently asked questions that's been issued by the AASB in conjunction with BDO on the accounting treatment of application fees and enrollment fees. Now, it's also a good opportunity to just flag that the AASB and BDO are working together on a project to prepare and finalize frequently asked questions for not-for-profit entities. These are published on the AASB's website after you know, the AASB staff is happy with it. So it's a project between AASB staff and BDO staff. So if you're looking for particular issues, please search AASB BDO not frequently asked questions, and you could find those. In particular, there's already two around schools, and there are also some frequently asked questions around research grants that's been received by not-for-profit entities. Around AASB 16 and PEPPERCORN leases, you know, do you have copies of all these arrangements? Do you have all the data to perform the calculations? Do you have a technology solution? And please contact me if you want to speak to me about BDO Lead or our BDO Lease Management Services. Also, you know, have you educated yourself, your team, your directors around these standards? Have you done a risk assessment? Have you designed an appropriate response? Have you come up with a project plan, implementation of these standards, implementation steps? Have you decided on a transitional approach? Have you run the numbers on both transitional approaches and then made a decision on which one you're happy to run with? Or have you just looked at it conceptually? Do you need assistance with that? And have you considered how you should change and improve your systems? Around impact assessments, at the moment, Kevin and I are really busy, and our wider team, assisting not-for-profit clients with impact assessments. And usually we structure it as follows. We first of all document the particular entity's current accounting treatment. Because we know current accounting treatment can be all over the place because the current interpretation of AASB 1004 is so different by different entities, different organizations. So we start by working with the client and clearly documenting their current accounting treatment, and in particular the timing of income recognition and the amount of the income or revenue recognized. Then we go through a whole process where we assess agreements, read agreements. Kevin and I are reading agreements morning, noon, and night to determine the new accounting treatment under either AASB 15 or 1058, whichever is appropriate. We consider the timing of income recognition and also the amount. And then in the third aspect of this impact assessment, we document how would the timing and the amount of revenue recognition or income recognition change. So it's a whole process to go through to get to the impact assessment. Quite often the impact assessment is summarized per agreement as follows. So we would look at depending on the number of years within the agreement or for how long the government grant, for example, runs. So in this example, it was a government grant for 3 years. And we said, all right, for 30 June 2019, currently, what is the impact on P&L? What is the proposed impact? What's the difference? Same for year end 2020, year end 2021, so that we can see the impact on the current year, but also what the impact will be for 30 June, for instance, 2020, 30 June 2021. And the impact, we usually distinguish between the impact on profit and loss and the impact on the statement of financial position. So I think it's really important that we don't just look at the impact on a particular date, the date of initial application, but look at the impact over the period of the actual agreement. So this is just an example that I wanted to show you to illustrate. So if you need any assistance, as I've said earlier, we do the monthly financial reporting webinars, and there's already been a recording that looked at AASB 1058. We also do monthly newsletters. And in our monthly newsletters, I've included links to the February, March, and April newsletters. And in particular, and I'll just show them to you, in every newsletter, we are including an article specifically for not-for-profits. So in this particular one, you can see performance obligations for not-for-profits. The diagram that we just discussed is there. Why is identifying sufficiently specific performance obligations important? Where do we find guidance? What are performance obligations? What are performance obligations in a not-for-profit context? How do you determine whether it's sufficiently specific or not? So it really expands on a lot of the things that we've covered in our webinar today. So if you register to receive our accounting news, it's every month. We try and put in one article specifically for not-for-profits, as a minimum one article for not-for-profits, but we also include articles on AASB 9, 15, 16, and all other recent developments. If you're looking for technical advice in Melbourne and also national, you can contact me. Sydney, please contact Kevin. In Brisbane, our partner is Clark Gerald, and in Perth, we have 2 IFRS advisory partners, Wayne Basford and Susan Oldmeadow Hall. And then our wider team, you can contact any of these people. So we've got a nice big team looking at these new standards. We're all very busy at the moment, and no annual leave in 2019. We'll rest at the end of the year. So questions, if you've got any questions, please feel free to contact myself or Kevin. And then we're saying thank you very much for attending this webinar. I know we've gone over time today. I do apologize for that. No discount next month, but we won't go over time. So thank you very much. I hope to speak to you again in May when we do our update on getting ready for 30 June 2019 financials. Thank you very much. Thank you very much, Kevin.
Thank you, everybody. Goodbye.
Goodbye. Thank you very much. Goodbye.